So we've been recently looking at new interesting investment themes, partly because we're getting concerned about the opportunity cost of holding on to Tesla. So we have to. There's two types of opportunity costs when you're all in, like we are with Tesla. We have also a large position in Nvidia, but Tesla is a large position. So we have two large positions, and there's two types of opportunity cost. One is the fact that you're not invested in other things, and the other is also that you tend not to look at other things, which is even more serious for a hedge fund manager. I think you need to stay on your toes. You need to be looking at other things. You need to understand what's going on elsewhere, partly because you might actually find something interesting, but also it helps you understand your own situation. And I think today's episode is a very good example of what that means. We looked at the electrification of the United States. It's not just the United States theme. This is a global theme. Europe, China, everybody's electrifying like crazy, and it's driven by AI data centers. So we looked at this. We are going to talk about two particular companies. One is GE Vernova, which is the spin-off of GE, the electrification spin-off, and then also Eaton, which is a company that has a couple of businesses, but the main business, again, is electrification. I'm going to explain what electrification actually means, and I'm going to talk a little bit about the prospects of the companies. The stocks have done extremely well, actually, recently. So these are interesting investments, and there's a reason why they're interesting, because we are, as a country, investing a lot in electrifying our infrastructure, and therefore these companies have a lot of upside. This is not Enron podcast. It's July 26, 2025. This is Krim Delco. For the year, we're down 13.4%. The market is up 8.6%. We're underperforming by 22%. So let me just talk real quick about the sort of philosophical motivation of opportunity cost as a hedge fund manager. So when you're invested in companies, in themes, let's say we are invested in the AI theme, so we believe that artificial intelligence is the industrial revolution of our time. It's a once in a lifetime opportunity to participate in wealth creation at scale. We're invested in Nvidia and also in Tesla. One is the workhorse of AI globally, which is Nvidia. The other is a company that is actually applying AI to the real world, and therefore changing transportation, changing the way we worked, changing a lot of things that are really impacting us on a daily basis beyond the virtual world, which is of course impacted by a lot of AI, like ChatGPT and Grok and things along those lines. So having said that, we are heavily invested in those themes, and it sometimes occurs to be invested like that because you don't look at other things. For example, we missed out on Netflix and Spotify, two entertainment companies that we believe are very good companies that we should have invested in. And also we missed out on the electrification of the United States. Now, this is a bit of a tricky argument to make, because the electrification of the United States is actually driven by AI. So you could say that we have a 30% position in Nvidia, which has done much better than any other company in the electrification space, because what is being electrified is actually data centers, and the data centers are driven particularly by Nvidia. In other words, if, let's say, GE Vernova gets an order, or Eaton gets an order to electrify a data center, it's because that data center at its core has Nvidia Blackwell or Nvidia H200s that are run for training. So this is an adjacent product. This is an adjacent theme, if you will, and it's done really well, but it's not done as well as the actual workhorse, which is Nvidia. So in that sense, and we've spoken about this a few episodes ago, it's sometimes tempting to say, well, we should be invested in electrification because of AI. But then if you think like that, you should just be invested in AI, period. You shouldn't be in an adjacent sector. So then that brings up the question, well, why should you even be invested in other sectors then? Why not just invest in the workhorse? And the answer is actually you shouldn't. I mean, you should really, if you have that kind of conviction, if your conviction is that data centers are driving the future of this country, then you should just invest in the one company which is driving those data centers, and that is Nvidia. This happens to be a situation now where NVIDIA is the workhorse. There's also Broadcom, and then there's also other companies like AMD and things like that. But the main company here is NVIDIA. Now let me talk a little bit about what do we mean with electrification. So we have in the US projections for electricity demand growth of about 3% per annum in the next 5 years. And this is kind of the horizon that we like to look at. 5 years is a good horizon. So in the next 5 years, we expect US electricity demand to grow about 3%. This is driven mainly by data center investments, and then also a little bit by relocation of industry. Now, that relocation of industry is a big question mark, but the AI data center investments, they're real. They are actually happening. When you build a data center, and that has been, there's a very nice slide on the Eaton deck of the Investor Day that shows what actually AI data centers consume in terms of electricity, and we're talking about small towns here. So when Tesla builds a massive data center, or xAI or OpenAI, they are basically adding small to mid-sized towns. So we're not talking New York City here, but we're talking maybe Palo Alto or Reno, like towns like that being added in terms of demand. So that's one big driver. The other driver that we think is still intact is the EV transition. So the transition from gasoline-driven cars to electric cars, which is, of course, driven by Tesla. As we are seeing globally, other than in China, nobody is actually successfully able to sell electric cars except Tesla. So Tesla is driving this transition. It is much slower than we expected. If we had predicted 2 years ago that Tesla will have probably 1.6 million car sales in 2025, we would have thought that that's wrong, because 2 years ago it was 1.8 million. So there's a decline in sales, which is of course very, very disappointing. And there's many question marks why that is happening. We believe that eventually Tesla will prevail because they're transitioning away from driving cars towards robo-taxis, and the Roadster, according to Lars Mondavi, the chief engineer of Tesla, the Roadster is sort of the last driving car. So it's going to be the car that will prevail as a car to be driven in a world where everything else is going towards a utility of miles driven, cost per mile, cost per mile, like that kind of transportation equation, away from the driving experience. All these advertisements that you see, experience the driving, experience this, experience that. Most of it will go towards utility scale, driving with robo-taxis. There obviously will be some off-road stuff, some camping kind of thing, and that, but those are niche markets. The bulk will be robo-taxis. So in that transition, we are now seeing a decline in sales, not because of the transition though, and that's the risky part of this whole investment. It's because people seem not to be too excited about electric cars, which is a problem in itself. But we don't want to talk about Tesla. We actually want to talk about the electrification of America. So let's get back to the point here. So electrification means that we want to electrify transport, and we want to electrify AI data centers. We want to basically electrify driving, and we are doing this in two ways. One is by putting electricity into cars so they can drive, and the other is also putting electricity into intelligence, which helps with mapping and driving technology, planning, vision, all of these things that are necessary for the car to drive. This is the first step, and then we believe that there is also a good case in point that we will eventually make transition labor also into AI-driven or Optimus-driven or humanoid-driven type form factors, where a lot of the labor that we are familiar with today, cleaning a car, serving food at a Tesla diner, those sort of things, and then increasingly other things like fixing stuff in a factory, all of these things will be done by humanoid robots. So again, labor, human hours will be transitioned into tokens per dollar, tokens per gigawatt, tokens per gigabyte. Those kinds of metrics will take over. And within that context, we need more electricity. We need more electrons. Jensen once talked about it. Tokens are value-added electrons, so we need more electrons. And the two companies that we picked for this episode, one is GE Vernova and the other is Eaton. Both of them fit really nicely into this theme because they are primarily invested in electrifying infrastructure. So whether it's electrifying a data center, electrifying a substation for a utility, electrifying a town, electrifying transmission lines, building high voltage transmission lines for data centers that are remote, building batteries, building monitoring technology, building transformers and substations, building voltage stabilization technology. There's a lot of moving factors here, and these companies are very well positioned in that space. So we expect a high double-digit growth in their businesses for that type of business. Both companies have other businesses. GE Vernova, for example, has wind, which is not a very successful business. They also have power, which is very strong. Power is where they actually build turbines, aeroderivative turbines and gas turbines, which are incredibly in demand also for data centers in particular. So GE Vernova is very well positioned also on that front. And unfortunately, they have wind, which is not a very good business. The reason wind is not a good business is because it has been shown that the wind turbines that are put in place actually don't have very good performance, and they need a lot of maintenance and repair and things like that. So those businesses are, I would say, valued at zero actually. So those are drags on margins, drags on growth. And similarly on the Eaton side, there's a little bit of like vehicle and e-mobility technology. They're small businesses though, 10% of sales. Again, not material. They have an aerospace business, which is interesting. It's about 15% of sales, growing because it's critical stuff. Aerospace is growing because of global demand, particularly in emerging markets. So that is a good business, but both companies are clearly driven by electrification. Now, what does it actually mean, this electrification business? And why is this so interesting? And we want to go back to the battery day of Tesla in 2020, when they introduced the idea to electrify the industry in the United States. This was the first attempt by Elon Musk and back then Drew Balino and others to spread the message that this country needs to get back to an industrial base, and that industrial base has to be built on electricity. Now, this, of course, has happened 100 years ago, so there's nothing new about that. So the new thing about this version is, of course, and we know by now, so 5 years later, we see where the breakthrough is. The breakthrough actually is in intelligence. So we're combining electrification of the industry with intelligence. So we're bringing an industrial revolution here that is roboticized, automated, autonomous. That's the future in which we believe the United States can play a big role also on the manufacturing front. There's no question that the United States needs to onshore manufacturing, and this is not a wishful thinking. This is national security stuff, and I think it will happen. This is not, the kind of thing that it reminds me of the Obama years when they spoke about the infrastructure investments and things like that, which actually never happened. Unfortunately, the government is not very good at investing and actually making things happen. But what the government can do, and where they actually have some clout, is by setting incentives with things like tax incentives and things like that, where we can actually incentivize people, or just tariffs, so preventing competition from the outside, so people here can build stuff that is important. And I think onshoring supply chains for critical manufacturing items, whether it's batteries, rare earth metals, any kind of thing that moves, electromagnetic moving parts, things like that. Those are the kinds of things that we will need in the future at scale, and I think that's where we're investing. So back to the electrification theme, this idea that we're going to electrify our future is really happening, and those stocks are a good example of why, of how you can make money with that theme. Now, the question, of course, for us is, should we sell some of our existing positions and reinvest in those electrifying companies? And the answer to that is, I would say, it tends to be no, because we want to stay with our investments, because we assume that we can make more money and more wealth, generate more wealth with the companies that we're invested in. So the only reason we would choose to change our mind is because we are wrong with our thesis. And with Tesla, we are questioning the thesis now because the Tesla core business is weak and the transition towards autonomy is very risky. So therefore, you have to increase the discount premium, and you can ask yourself also the question whether you're actually right about this. Maybe you're wrong. Maybe this will not work. So those are the kinds of questions that we have to ask ourselves as investors, and that we're actually in the process of asking ourselves. One interesting observation that I made when I was working on, let's say, Eaton and GE Vernova is that once you work with these kind of, let's say, legacy type companies, you realize that their whole demeanor, their whole culture is so different than the companies that we're investing in right now, NVIDIA and Tesla. Their speed is much slower. They're using a lot of consultants. It's just a very, I would say, slow-paced and, quite frankly, complacent, process. The people are fine. I mean, I don't want to question the quality of the people. They're all highly educated people who run these companies. But you can see just, the CEO of Eaton has been, I don't know, decades with a company called Cone, which is a crane company. So it's just, look, nothing wrong with these things, but those are legacy businesses. Those are businesses that are used to slow pace, and yes, they are taking advantage now of this boom in AI, and they're happy to sell products and services. But I have to question whether these kind of companies can keep up with the pace that is necessary to satisfy the demand that the AI token factories are requesting. So that's certainly one question we have to ask ourselves. And as investors, we really have to ask ourselves hard questions. For example, if we take a 20% discount rate, which is our cost of capital now, then the stocks, whether it's Eaton or GE Vernova, they don't work for us, right? They work with a lower discount rate, let's say 10-12%, which is kind of normally what equity premiums are in the United States, maybe a little bit higher now because of interest rates, but that's kind of where legacy businesses like that should be. And for us, the discount rate is 20%. That's the discount rate. That's what we're living with because our opportunity cost is Bitcoin. And of course, Tesla as a company can fulfill that discount rate because there is enormous amounts of upside in autonomy. Some of the parts of Tesla is that we get to about $80 for the car business, another $80 for unsupervised FSD, and about $60 for the energy business. Let's call it $80. So $240 for these three businesses, and then we have another about $220, $250, something like that for the robotaxi business. So we get to about $450 to $500 per share at a 20% discount rate. So that's kind of how we think about Tesla. And of course, you can already see in this math that half the valuation of the company is a robotaxi business, which doesn't even exist right now. So this is, of course, a massive, massive risk. But how else can you make 20% returns if not with these types of investments? Now, the big question for us, of course, is then should we actually even invest in Tesla? Why don't we just buy Bitcoin and make those 20-something%, which is roughly what we expect to make with Bitcoin? That's the big question. We don't have a good answer for that other than that, quite frankly, the answer is more like, look, we just want to be working. We want to have the feeling that we're contributing to progress in humanity. And we don't just want to, hide behind the exact opposite of progress, which is what's driving Bitcoin. The reason Bitcoin is such a good investment is because we have profligate spending by governments, we have debt financing, inflation, and all of these things, which is a whole different topic. So to summarize, this was a little bit of a haphazard episode. I apologize for that. It wasn't a traditional stock analysis, and it wasn't meant to be. We're not an investment bank. We're not we don't sell analyst research or things like that. Our goal is to generate wealth by investing in fundamentally new concepts and engineering practices. So we have to find investments that are, along those lines. And GE, Vernova, and Eaton are not. They're a good theme, but they're driven by something else, and that something else is AI. So that's the actual theme, and we should be laser focused on that. We should also be very conscious about the idea that we can't electrify and change, we can't electrify this country and change the way we produce things with legacy companies. That's not going to happen. What's going to happen is that it's going to be the startups, it's going to be the new American dynamism companies, of which Tesla, NVIDIA, many others here in Silicon Valley and in the sort of sphere of Silicon Valley are. It's not going to be legacy companies. Legacy companies will continue to make good money, deliver high returns, but for us, given our mission, the idea is to stay laser focused on the mission of transitioning into a sustainable energy future with an electrified country that is using a lot more energy to replace human labor with robotics. That is the key. We are invested in NVIDIA and Tesla for that. We are not investing in companies like in GE, Vernova, and Eaton. Again, not because they're bad companies or anything, they just don't fit into the kind of structure that we as a fund are interested in. Our cost of capital with 20% is too high for companies like that. If we chose to exit investment like Tesla, then the prudent thing would be to just buy Bitcoin. Thank you.